Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq 100 Index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Friday afternoon, we have Mark Marex, product development specialist with Nasdaq Index Research, to review Nasdaq 100 valuation in the context of intangible assets. Mark, this sounds like we have a lot to unpack. Thanks so much for joining. And I'd like to start off with reviewing where we are with Nasdaq 100 valuation.
Thanks, Jill. Great to be here as always. This topic of intangibles has been coming up more and more, I think, in the financial media the past couple months. Certainly a relevant topic to talk about, considering just how much tech and sort of new economy sectors have outperformed this year in the context of COVID. What I wanted to start out with was just a very high-level look at what the PE ratio and what the price-to-book ratio for the NDX index has looked like over the past, call it, almost 20 years. You can see the PE, even though it's shot up recently to over 30, we're actually still below where we were for most of the early 2000s. So from a straight sort of earnings multiple perspective, we're not that expensive, although starting to get a little bit expensive versus kind of historical averages. And that's the purple line. But look at the blue line. That's the price to book, which, when you think about book value, you think about tangible assets, you think about, accumulated earnings in a company's balance sheet. We went from a book value of 3 in 2002 for the index to now almost 7.5. And that's a really big and interesting, I think, dichotomy in how the two different valuation measures have diverged, especially over the last 2 to 3 years, let's say. And that, I think, really ties into this broader conversation around, why is value as a factor underperformed for so long? Is there something, very fundamental that value investors are not capturing in their methodology in the same way that growth investors are capturing, where the focus tends to be a lot more on revenue growth and on earnings growth. And I think that applies to the Nasdaq 100, because if we take a look at the next slide, what we see is, the same time period, essentially, the trend between earnings per share on the index and R&D expense per share. And you can see that from an earnings perspective, we've absolutely crushed it, right? Earnings per share are up almost 10x over that time period. The fundamental story for the Nasdaq 100 companies is generally very strong. Earnings are not an issue in terms of, our valuations justified on the Nasdaq 100. It's really measures like price to book and others that are related to it. And when you think about, all the R&D, research and development, that companies in Nasdaq 100 undertake, you can see that has grown by a factor of almost 6.5 to 7 over the same time period. The way in accounting rules we treat R&D expenses, it's just expensed, right? There isn't an asset created when a company spends money to produce a patent or to produce some piece of software that they end up, being able to leverage to grow their revenue for years and years. And so what people are starting to talk about is, well, it's an accounting rule. We expense R&D. We don't create intangible assets off of it. Should we sort of adjust how we're valuing a company's balance sheet to take into account all the money that's going into R&D that is at the same time decreasing company earnings, but also being responsible for, Amazon, Tesla, Netflix, Microsoft being able to grow their revenues as much as they have over the past 10 or 15 years and stay very profitable. So the other, if we go to the next slide, the other kind of major part of intangibles when we think about it is brand. And what I've done here is, this is just one of the few firms out there called Interbrand that kind of does this annual survey of what companies' brand values actually are represented in the market. They have a pretty interesting quantitative and qualitative way of coming up with this. But you can see in this chart the top 4 companies are the top 4 largest in the world, also the top 4 largest holdings of the Nasdaq-100. You've got 16 of the top 60 in total in the Nasdaq-100 index that are either straightaway companies or subsidiaries, like you've got Instagram in there for Facebook, you've got YouTube in there for Google as well. So not just R&D, but these companies have really, I think, grown their brand values as well over the last decade and a half. And that is, again, not something you see on the balance sheet, not something that book value captures. And that's part of the reason why some of these valuation ratios get so out of whack. So if we go to the very last slide now, this is kind of where it all comes together. If you look at total market value of these companies versus total book value, you get that very high book value, price to book value ratio of almost 9. This is unadjusted for index weight. This is just summing across all 100 companies in the index. And what I've tried to do is take R&D expense and say, okay, whatever you expense, we put it on the balance sheet, we depreciate it at 15% a year. And for SG&A, which includes advertising expense and things like software and client lists and things like that, we're capitalizing 30% of it a year and also depreciating it at 30% per year. So if you look at that for the 100 companies and you add that to what's actually reported on the book value, you can see just how materially it impacts valuations. You go from almost 9 to, when you add in book R&D, you get a book value ratio of 6. When you add in further that SG&A expense and you capitalize it at a fairly low rate, you get all the way down to 5. So you're all of a sudden looking at a totally different valuation picture. And it's because of these intangibles, the way that we've decided to treat them from a legal and accounting basis just really is not capturing the value of these companies in today's day and age.
All right, Mark, great stuff. Thanks for joining us on Trade Talks.
Thanks, Jill. Talk to you next time.
All right, you got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.